Welcome to all of you here today, both in downtown Chicago, as well as those joining us virtually from your offices and homes around the country. Again, I'm David Snyder, President and CEO of the Economic Club of Chicago, and I'm delighted to be joined by two ECC members for today's program. First, our moderator, Ann Dwyer. In 2019, Ann was named editor of Crain Chicago Business, the first woman to lead the newsroom since Crain's founding in 1978. She joined Crain from the Chicago Tribune in 1995 as a copy editor, eventually moving to the news desk and later running some of the publication's highest profile features, including 40 Under 40, Best Places to Work, and the Fast 50. An award-winning journalist, Ann not only leads the newsroom operations, but writes many of Crain's weekly editorials. In addition, she is frequently the broadcast voice of Crain's, regularly appearing on the BBC, WTTW's Chicago Tonight, and WBBM's Noon Business Hour. Ann is a graduate of the University of Illinois, Urbana-Champaign, where she studied English and journalism and was both a reporter and editor for the Daily Illini. Now on to our speaker. Austan Goolsbee is the recently named President and CEO of the Federal Reserve Bank of Chicago, which gives him a seat on the Federal Open Markets Committee, the body that sets the nation's monetary policy, including the Fed's fund rate. The Chicago Fed District, made up of Iowa, most of Illinois, Indiana, Michigan, and Wisconsin, conducts research and monitors local economic conditions in support of the formulation of monetary policy, supervises and regulates banks and organizations and others that provide financial services to banks. Austan previously served in Washington as a member and then later as chairman of the Council of Economic Advisors, where he was a member of President Obama's cabinets between 2009 and 2011. A longstanding professor at the University of Chicago's Booth School of Business, he has a doctorate in economics from the Massachusetts Institute of Technology and studied for his master's and bachelor's degree in economics at Yale. His research has earned him recognition as a Fulbright Scholar and an Alfred P. Sloan Fellow. He was named 100 of the most powerful global leaders of tomorrow by the World Economic Forum and one of 6 gurus of the future by the Financial Times. His ability to explain economics has made Austan popular in the media as well. Jon Stewart described him as Elliot Ness meets Milton Friedman. And he's been twice named as a star professor by Business Week's Guide to the Best Business Schools. First, we'll hear remarks from Austan. Then he will sit down for a moderated discussion with Ann. Austan, welcome to the Economic Club, and we look forward to your remarks.
Thank you, David, for that lovely introduction. Not to ruin a good lunch, but before we sit down to discuss the economic chat, as David said, let me take 20 minutes and talk to you about monetary policy. Seems like some things never change. The Economic Club of Chicago, for the 2,656th time or whatever, is here to discuss the issues of the day. This past weekend marked the start of Chicago's heralded 10 days of spring. And our beloved Cubs and White Sox have had their home openers. If the playoffs started today, they would both be eliminated. So, some things are new, though. I started as the president of Chicago Fed in January. That's been quite an experience. In my short time on the job, I've already voted to increase the Fed funds rate 2 times, and I can't help but note that my predecessor, Charlie Evans, took him more than 8 years to do that. The environment is, of course, much different now than it was when he started in 2007. So the first thing I did when I got to the Chicago Fed is I've been traveling around the district to hear from people, from businesses, community organizations, et cetera, about the economy. As David said, the district really covers the heart of the Midwest. And I've heard from a lot of people in a lot of places. Turns out, people have a lot of strong opinions about the Fed right now. Now, speaking of opinions, this is the spot at which I will officially say, and our general counsel's here, and it's like, good. Okay, I need to say that the views I am expressing are my own and not necessarily those of my colleagues on the Federal Open Market Committee or in the Federal Reserve System. Okay. So, without further ado, literally the law assigns the Fed two monetary policy jobs: maximum employment and stable prices. And when inflation gets too high, as it has been for the last couple of years, the Fed fights it with really the only main tool that it has: cool the economy with tighter financial conditions. That's why, of course, the Fed has increased the federal funds rate as aggressively as it has, almost 5 full percentage points, almost 500 basis points in the Fed language over the last year. We all know that it takes time for these policy moves to work their way through the economy. And we all know it's hard to figure out how long it will take and how much is enough. And that is why we always say that central banks need to be data dependent, which literally just means to watch how things are going and adjust the policy accordingly. Okay, so fast forward to the data at the end of last year in 2022 and the beginning of 2023. I said fast forward. Rewind to the end of 2022, beginning of 2023. The data were surprisingly strong. Despite almost 500 basis points of raising the interest rate, spending held up, job growth was truly remarkable, inflation did not come down by very much. And based just on the data, you would think that the Fed would be now pressing more aggressive policy moves than we were, say, 6 months ago or in past times, just based on data dependence. Yet, if you look at the summary of economic projections, which is a forecast that's made by all the Federal Reserve governors and the Reserve Bank presidents, it came out at the last FOMC meeting in March, the expectations of where the rates are headed for the rest of this year barely moved from where they were at the end of last year. And of course, that's because those projections include some assessment of this new big hairy elephant in the room, which is the fact that two significant banks failed in kind of a high-tech version of an old-timey bank run, and that triggered broader financial market turmoil. To restore calm, the FDIC and the Treasury and the Fed together stepped in, guaranteed all the deposits at these banks, not just the ones below the FDIC cap. They created a massive new lending facility. They enhanced the existing discount window. All of these actions to try to prevent further runs on the system. So today, what I want us to think about is why I think that at moments of financial stress like this, the right monetary policy is really caution and watchfulness and prudence. And I don't say that because I think we should stop prioritizing the fight against inflation just because markets got upset. That is a perspective that I call financial dominance, which holds that financial issues are more important and they should dominate monetary policy concerns when they conflict. There are people who believe that those financial conditions should drive Fed action, but I absolutely don't. I think Congress gave us a job. Well, it gave us two jobs: maximize employment and stabilize prices. That's the job. That's written into the law. It doesn't say anything about the stock market. It doesn't say anything about always keep the financial markets happy. It doesn't say anything about make sure investors don't lose any money. So the reason why I say we should include the financial conditions in our monetary policy discussion is just that history has taught us that at moments of financial stress, even if they don't escalate into a crisis, they often mean tighter credit conditions and have a material impact on the real economy in a way that the Fed absolutely needs to take into account when setting the monetary policy. As I'll explain, I think that in today's environment, actually there is no conflict between our current monetary policy and these potentially tighter credit conditions, especially if those credit conditions are going to be part of strengthening the financial system. They will, in fact, work in tandem to cool inflation. But we also need to recognize that this combination of policies is probably going to hit some sectors and regions of the country in ways that look different than they would if monetary policy was acting alone. Okay, so first, if you are old enough to remember 2008, and it looks like a few of you are old enough to remember 2008, or if you aren't old enough to remember, but you are a student of financial history, then you know that when financial stress snowballs into a full-blown financial crisis, the entire economy suffers immense harm. The workers, businesses, financial institutions, consumers, everybody. And that is why when financial crises come, central bankers and really all the policymakers act as quickly as they can to provide support to the economy. They cut rates, they expand quantitative easing, they pass stimuli, what a variety of things. Side note, moments of financial stress are a particularly bad time to punch yourself in the face by taking actions that could ignite a financial crisis on their own, like, say, defaulting on U.S. Treasuries in a fight about the debt limit. When I was a kid, I dreamed of starting a guidebook series of places that were awful called Let's Not Go. And that dream died when I realized nobody wants to buy a guidebook for a place they have no interest in going. But if I had started it, I would write one about defaulting on U.S. Treasury and the debt limit. Let's not go there. That's a surprising ovation for the debt ceiling fight. But even the thing that's important is even if financial stress doesn't spiral into a crisis, it still often can lead to a pullback in credit and have a material impact on the real economy. Okay, the research is really full of studies that show exactly that across other countries, across time. In U.S. history, think of the fallout from the savings and loan crisis of the 1980s and 90s. That one didn't spiral into a financial crisis. But it did make the 1990-91 recession significantly worse. It did significantly slow GDP growth in the subsequent recovery. And that's the danger. That's the fear. I'll be the first to admit that these historical episodes are not necessarily perfect analogies to what's happening today. I mean, first of all, the bank situation and the market turmoil has definitely quieted over the last couple of weeks. Second, the financial system today in the U.S. is much less reliant on bank credit than most other countries are, or than the U.S. itself was 30, 40 years ago. But still, at the very least, we need to be on watch for the possibility of these tighter credit conditions, that banks could pull back on lending in order to protect their balance sheets. The Fed's own senior loan officer opinion survey, known in the business as the SLOOS. The SLOOS suggests that there was already tightening of the lending standards going on before Silicon Valley Bank and Signature Bank even had their failures. So if these financial headwinds develop, the Fed would need to account for that when setting monetary policy. In some ways, it's almost just mechanical that we've been tightening financial conditions through the Fed funds rate and others to bring inflation down. So if the response to these banking problems leads the financial industry to tighten on its own, then monetary policy has to do less. It's not clear yet exactly how much less, but one indicator, the private sector analysts have speculated that what's happened so far might amount to the equivalent of raising the federal funds rate by something in the range of 25 to 75 basis points. That is 0.25% to 0.75 percentage point. We need to get a handle on the size of the financial headwinds, and that's why we need to monitor a wide variety of financial indicators. To me, in a way, this is just the newer, funkier version of the same old data dependence moniker that we've always applied. And I would also say that out here in the reserve banks, not in Washington, D.C., we're also going to go out and talk to a lot of people, because hearing what the households, the banks, the businesses, the community groups are experiencing often reveals things that have yet to show up in the formal data, which tend to get released with a lag of at least a week or a month or even a quarter. So given how much uncertainty abounds when these financial headwinds are going, I guess I think we need to be cautious. We should gather further data, and we should be extra careful about raising rates too aggressively until we see how much work the headwinds are doing for us in getting inflation down. So now let's think for a second about what's the first line of defense when you encounter financial stress. There is a branch of the financial dominant school of thought that I mentioned before that takes that argument even further and says that if there's any chance of financial crisis, that we should preemptively cut the rates to try to reduce the odds of it becoming a problem. I think right now we got to be careful with that logic, given A, that we've had substantial trouble getting inflation down in recent years, and B, there are dangers of setting a precedent that we will give in anytime the market throws a tantrum. The main defense for avoiding or mitigating financial stress, in my opinion, should be the supervisory and regulatory tools that we aim at ensuring safety and soundness of the financial system. They include capital and liquidity requirements, stress testing, supervisory examination of the bank portfolios and the risk management practice, and pressing on all of those dimensions to strengthen the financial system will help it weather stress events like these recent bank failures. And it's worth noting on the side that our financial situation today is significantly better because of the financial regulatory reforms that we put in place after the great financial crisis some decade ago, particularly higher capital and liquidity buffers that we required of our largest financial institutions. Thank goodness that we did that. The last point I'd like to raise, I would lump under the topic of unusual circumstances that it's worth noting that there are a few different ways that the impact of credit conditions and monetary policy right now may look a little different than they normally do. A, the economy's still coming back from bizarro COVID times, as you know. Initially, people spent more time at home, let's call it. We saw a huge surge in demand for durable goods like Pelotons and others, and a plunge in the demand for services like travel or going to the dentist or things like that, looking nothing like a regular business cycle. That's the opposite of what happens in a regular business cycle. Now, more recently, consumer spending shifting back to the services, and that's reflected in the inflation data. So goods inflation has come way down, but now services inflation, especially in the categories where spending is discretionary and was repressed for a few years, like travel, hotels, restaurants, leisure, recreation, entertainment, the economic club, all of these, demand has returned and the inflation has proved particularly persistent. I'm not saying anything, David, about what's happening to dues. I mean, that's your own business. Now, Did somebody hiss? Somebody hissed when I said dues. This is a cold family, David. I apologize. B, today we do not face a common dilemma that is found in many of the earlier moments of financial stress. That is, our financial stability goals and our monetary policy goals do not conflict. So often, moments of financial stress happen when the macroeconomy is really struggling. And the kinds of actions that the financial institutions need to take, or that the Fed or the other regulators force them to take, like tightening the lending standards or conserving or raising capital, things like that, that strengthen the banking sector, simultaneously reduce the availability of credit at exactly a moment when the economy cannot afford to be slowed down. But at present, we don't face that dilemma. So the actions that we take that strengthen the banking sector's financial position and reduce the likelihood of these financial stresses to spiral into a crisis, they're actually making the job of monetary policy easier because they're tightening credit and bringing inflation down on their own. C, it's worth also remembering that the credit conditions and monetary policy now, their impact might look different than in historic tightening cycles, if only because much of this recent financial turmoil has seemed to be concentrated in the regional bank sector. So if a potential credit crunch gets concentrated there, it's going to mean that the sectors and the geographies that are exposed to those regional banks and institutions will probably feel the impact of the tighter conditions more intensely. Those institutions are particularly important sources of credit for credit cards, mid-sized business funding, and lenders for commercial real estate and autos. So different parts of the country, as well, different parts of the country are more reliant on regional banks than others are. So I wouldn't expect things to look like they're going to be felt equally by all. At the end of the day, as I said, the best central bankers are data dependent. And the Fed's job is to be more paranoid than anyone else. That's what they pay us for. In lucky times, we don't need to follow that many different data series to decide where we think inflation or unemployment or GDP are headed. But in unluckier times, more interesting times like the times we're in right now, with wild shocks and financial stresses, it means we have to dig into loads of new information to try to figure out where the economy's headed and to set monetary policy. The Fed must use everything in its toolkit to maximize employment and stabilize prices. That's definitely harder in an unpredictable world that's full of pandemics and wars and cryptocurrencies and bank runs, but we will figure it out. This is Chicago, and we know how to get the job done, no matter what the conditions are. We know that there is no bad weather, there is only bad clothing. So take comfort in this. The financial stress may come and go, but the Fed is forever. Unless these conspiracy nuts succeed at abolishing the Fed, at which point you're all going to be on your own. But at that point, Ann, why don't we come up and have a talk?
And among the things I wanted to do today is to sort of drill down a little deeper into some of your remarks and localize them if we can. But first I wanted to start with just a little bit of just biographical background on you. Born in Waco, Texas, correct?
Indeed.
Raised in Whittier, California?
Where is this going?
Well, I understand
yes,
that's where one Richard Nixon
Richard Nixon,
was
that's
raised?
right.
I see the connections immediately. Yeah. I'm going to go home now and add another string of red yarn to my conspiracy theory chart. It's all making sense.
There is a Fed connection with Richard Nixon. The Watergate break-in took place at the Watergate Hotel, but was discovered. The Fed has a law enforcement unit. There are Fed police officers. And the break-in was discovered by a Fed police officer.
Is that right?
And so the conspiracy nuts have this whole thing that the Fed did Watergate and it was an inside job.
We're feeding that.
Yeah.
Sorry. But just to back up to young Austin, child star, Whittier, California, what drew you to become an economist to begin with? I mean, most kids aren't dreaming about, they're looking at astronaut, baseball player, economist.
I knew I liked math and science, and I knew I liked debate and politics and policy. And in my younger days, I wasn't totally wrong. It kind of seemed like economics was a combination of those.
Yeah.
And I went to the high school guidance counselor who said, what do you want to be when you grow up? And I said, maybe I want to be an economist. And she started laughing. And I said, why is that funny? And she said, because my husband is an economics professor. And that husband, so she said, I think I can, you can find out about it. And, and that her husband kind of took me in and took me to seminars and would show me economics, and I got into it from that. And like a lot of people, even if you hadn't necessarily intended to get into something, if you have mentors and great teachers, you kind of take it up. So that was the path. That was the path I've chosen.
And here you are today, making that professor proud, I'm sure. I was going to ask you if the transition from being tagged as America's funniest economist to being in your current role has been a difficult one for you. I realize that America's funniest economist is a low bar.
First of all, let's have a fact check. It was DC's funniest celebrity, and it was a contest, and I won the contest.
You're very proud of that, I can tell.
But as always, I say that the central question of economics is compared to what?
Yeah.
And nowhere was that more true than at the DC's Funniest Celebrity Contest,
Right.
where I was the winner and the runner-up was Grover Norquist.
Grover Norquist. Yeah.
And my wife, who is here
Noted cut
now,
up Grover
was at
Norquist.
the contest, and I was the last person to go. And she whispered, honey, if you can't beat these people, you're going to have to slink out of here because nobody's gotten a single laugh the whole night.
That would be sad. Well, it does seem, and we joked about this in the green room earlier, that as a communicator, you're no Alan Greenspan. You say what you mean and mean what you say. But truly, what you say can potentially move markets.
You're making our Fed people sweat here. They already were very nervous
That's
about
why
me
I'm here.
getting up.
Yeah. But so how circumspect do you need to be in moments like this where what you have to say could potentially really have an impact on?
I've always liked to carry myself with a certain quiet dignity.
Yes.
But look, the thing that I outlined in the remarks or tried to, I think that for the central bankers of the world, as you know, there's a emphasis especially in the business media of just kind of like, so does that mean you're for 25 or you're for 50?
Right.
And they want to know that.
Yeah, guilty.
And I think it's more informative, rather than just asking the opinion of everybody on the FOMC, it's more interesting, maybe is the right word. What are you looking at? What data are you watching when making that decision? And so you don't have to be circumspect about that, I don't think, because what's the reaction function of the central bankers?
Well, I could take
It's
a
good
hint.
that we have that.
All right.
No, you're like, is it 25 or 50? No, I'm not.
No, but I was going to say, and you're jumping ahead a little bit in my notes, but I was going to ask you, your assessment of the situation obviously comes from various qualitative factors, including reports from members of your own board and discussions with CEOs and business owners, other constituencies in the district. So you're just starting in your role, but how do you personally get that feedback? And if you had 3 questions you want to ask a room full, of CEOs and executives here, what would they be? And we could even do a show of hands. Are there things, is there data that you can gather from this group?
No questions. Okay, all of those, but both of these are quite important. One, the Chicago Fed itself has an amazingly distinguished research department of a lot of people. I think 125 people that have for sure kept me on my toes. And I can't get away with it. If you're an economics professor, you can have a loose opinion of like, it seems like all of this came from supply shocks.
Yep.
And the research department of Chicago Fed will come back and be like, here's a 5-page memo of why you need to stop saying that. You know, and I love that. I mean, their quality is super high. And then the second style of information is what you say. I like talking to our board. We have a very distinguished board, and some of the members of the board are here this afternoon, that will give us, every time we have a board meeting, we go through and gather those the conditions, what they're seeing in terms of demand, in terms of credit, in terms of supply constraints. And then we have a very robust, formalized effort to reach out and talk to businesses and community groups of many forms that go into what the Fed calls a beige book,
right.
Which is regional intelligence, let's call it. And we'll talk to major employers and manufacturers and service companies, because, like I say, the data tend to come out with a 1-month lag.
Yeah.
When the jobs numbers come out, it's for last month.
Right.
And
then they
when the
adjust them.
GDP comes out, and then they adjust them for 2 years. They adjust them.
Right.
Okay. And the GDP comes out a month after the end of the quarter. So if you're just waiting to be data dependent on data that's actually applying way back when, you're behind the 8 ball. So we like to supplement with that. If we were in a setting right now, the foremost thing on my mind before our next meeting in May is trying to get a handle on this question about credit. And is it actually credit tightening? But until the financial stress, the puzzle kind of was, we raised interest rates as fast as they've been raised in decades. And yet the data continues to come in extremely strong. Does that mean there's a big anvil kind of floating around over us that is about to drop? It's just taking a while? Or was it paper mache? You know, and it was not an anvil. So I would have 3 months ago asked about that, but now I think it would be about credit conditions, and is that going to be a limiting factor on expansion?
I think here in Chicago, and certainly in the Loop, it feels like we're in the shadow of an anvil.
You feel like the shadow.
Yeah, I mean, just speaking for myself. You could ask these folks. In that, especially with the downtown office market, we're seeing,
the whole space of commercial real estate. This is kind of what I was hinting at a little with we've gone through a totally bizarro time through COVID. And if you look at the folks that do the surveys of downtown office buildings and how many people have returned to work, Chicago actually has had the highest return to work ratio outside of Texas of any of the places that they measure.
We're at about 48%.
And yet it's still about 50%. That's what I say. But 50% seems super low, and yet that's higher than most other places. So we're going to have to work through this. I don't know. I mean, at the Chicago Fed, we are confronting the issues just like everyone else of how many days a week are people going to come back, and how much of the job needs to be done on site or from home, and we were just going to have to work through that.
Well, so much of the answer to that equation, I think, and I agree that it's going to take a while for it to really work its way out, but so much of that does seem to be tied to talent and demand for talent and what people in the workforce are willing to do.
Indeed.
So talk about that a little bit. I mean, just workforce demand and where you see that headed.
The job market has been almost literally unbelievably strong.
Yeah.
If I had told you the unemployment rate was down to around 3.5% again, as it was, as we came to the end of last year, and I asked you to predict what will happen to the jobs numbers, everyone thought we're going to run out of bodies. We're going to run out of people. This is full employment. This is what it has to stop growing faster than population growth. And the baby boomers are retiring. Labor force participation is supposed to be coming down.
Right.
We've put up epically huge jobs numbers, even from starting at that point. So it certainly feels like the job market is extremely tight. Yet, the GDP slowed down, and there are others, like wages are up, but they're not up faster than prices. So business margins actually expanded over the time when the job market was supposed to be as tight as it ever was. And so they're just weird puzzles. I mean, they're weird puzzles.
Yeah.
It feels like the job market is cooling a bit. You've seen some layoffs. You've seen some slowing of the growth rate, let's call it.
In certain sectors, certainly.
In certain
tech.
sectors.
Yeah.
But it feels more like the overall economy, rather than the traditional Fed-induced tightness goes at the interest rate sensitive parts of the economy. And those interest rate sensitive parts of the economy are the most cyclical, so it's usually easier.
Right.
That part is not as easy now because the service sector being overheated, the service sector is kind of the less interest rate sensitive. Do you care what the Fed funds rate is when you decide whether to go to the dentist? Nowadays, maybe you do, but historically not, and so that's kind of a harder part.
And yet, those fluctuations do have their impact on certain aspects of the economy that, especially here in Chicago, maybe are a little bit more sensitive than in other regions of the country. I would wager. We are a middle market town here, in a large respect. I mean, obviously, we have large corporations in Chicago, but bulk of the economy is small and mid-sized companies, and we certainly are a very fragmented banking market as well compared to other major metros. So for smaller and mid-sized businesses...
That was the Crain's flex there.
Yes.
You heard that?
Yes.
Like, this woman knows what she's talking about.
It's all written down for me, really.
Yeah.
These are companies that really do rely on access to loans and lines of credit to get the job done. So how do you see higher rates and tighter lending requirements affecting the growth of the local economy here in Chicago and in the Midwest? Your remarks earlier really spoke nationally.
You would have thought, historically, in a way, the Chicagoland economy has a higher beta, let's call it. It's more of everything that is cyclical. We got higher manufacturing, we got financial services, we've got a lot of logistics and transportation. Yeah. Though we also have a lot of professional services. And I would have thought that as the interest rate goes up, we would have, in conversation with our manufacturing throughout the district, not just Chicago, but when we talk to manufacturers, I would have thought they'd be like, you're killing us. This is the tip of the spear, and we're going to suffer. Kind of surprising that we hadn't really heard that. Part of it, I think, is we have a lot of orientation around the auto industry, and the auto industry was massively supply constrained. From the chips to the ports to the blah, blah, blah.
Right.
And so now, yes, demand is cooling because the interest rate's going up. Auto finance getting more expensive. But at the same time, it's hard to injure yourself jumping from the window of the basement. In this thing, they're saying, well, yes, demand is down somewhat, but we finally are getting cars again. And so, so their sales are in some ways going up. So that's masking a little bit. The easing of the supply constraints is masking a little bit what I would have thought would be Chicago, takes a punch to the gut before others.
There's no question that these are bizarro times. That's going to be my new technical term for this from now on. And yet, if you listen to epidemiologists and people who are looking at just the COVID ramifications that are probably going to echo through our economy for quite some time, we are going to have another pandemic. They are, I'm sorry to be the one.
Way to be a downer,
so.
Ann.
I'm sorry. I mean, so it's 100 years since the last one, but, there's been predictions that we're going to see this again in some way, shape, or form, and hopefully the response next time will be better and more coherent than the last one. But are there lessons that we can and should be learning out of this? Are there things that you want to underscore and emphasize for the next time we run into a massive event like this? Because it seems likely that we're going to be seeing more.
I guess I would only say, well, look, what do I know about epidemiology?
I don't know.
Maybe like a little. Though I was not to mention the competition, David, and I apologize. You will remember that in February of 2020, I spoke at the Commercial Club, and you remember my whole thing was like, you keep your eye out for this thing in China. Pandemics don't stay where they start. If this gets here, we're going to have a horrible recession. Everybody's like, what are you talking about? And but then everything went. Everyone went home, so I couldn't go to the next meeting and be like, see, I told you, because there were no meetings for 2 years.
You're on Zoom.
It's worth remembering there were some positive lessons. We actually came together in a totally unpredicted, bipartisan way and did a bunch of things at the beginning and through COVID times. And I hope and the Fed reacted a lot and interacted. I was suspicious at that moment that they were putting too much on the Fed, kind of like Congress is going to hand the Fed, here, you do it. And then if it goes wrong, they'll be like, oh, the Fed screwed it all up.
Right.
So I was kind of paranoid about that. But that didn't happen. In a way, despite the environment being as toxic as it is, there was a major accomplishment to work in a crisis moment the way they did. I hope that there would be some lesson that we could do that again. I don't know that there are obvious, specific, technological, economic lessons like go do X. Should you give money to the unemployed? Should you do PPP style lending to businesses? All of those, I kind of think you got to play by ear. But the main lesson that you want to act quickly when you face shocks like that, and you want to rely on enactable facilities. So the Fed, in a bizarre way, was able to act quickly because we had lived through the 2009 crisis, 2008, 2009, which looked totally different, but the conception of we can stand up these facilities, we can act in various ways, hopefully would do that. But I got to stay out of the politics of the
Understood.
Of that moment.
Would you rather be sitting in the chair you're sitting in now or in 2008?
This is a comfortable chair.
It's a nice
but
chair.
You mean in 2008?
Yes.
Oh, now feels so much better than in 2008.
Yeah.
Maybe it'd be different if you said in February, late February 2020, was that better or worse than 2008? I still think it'd be better in 2020. There was more death. That was the worst part. But just the economic part was intensely scary, but it was very rapid. So the month of March 2020, the unemployment rate went up more in that month than in any year in U.S. history, including the Great Depression. We had a Great Depression for 1 month, and it was awful, but then it came rebounding back pretty rapidly. And given that you know the world didn't end, it's a lot better to be in that moment.
Yeah, the world didn't end. We're still here. But you did mention, worrying earlier about the Fed perhaps, putting itself in a position to be perceived as perhaps not handling that crisis as well as it did. That didn't happen. But lately, since the banking crisis has come up, the Fed has been, come in for some criticism for its handling of supervision of the banks that have struggled, and maybe others. Has oversight become too lax? And President Biden and many others are calling for tightening supervision over banks. Do you agree with that? And just wondering what more can be done.
The Fed is the regulator of a lot of financial institutions, not all of them, but that's done out of Washington. So it is delegated from Washington to the regional banks. That's what makes us the regulator, but we don't set the policy. Washington sets the policy and tells us, here's what we want you to apply. I do think that Silicon Valley Bank, being under the regulatory umbrella of the Federal Reserve System, means that the vice chair of supervision, Michael Barr, who is a person that I respect a lot and who I worked with closely through the financial crisis in 2009, he's now the vice chair of supervision in Washington for the Fed. He's said that by May 1st, they're going to release a thorough report to figure out what went wrong and did they identify it? Should they have done something else? How did the changes to regulations over the last 4 years affect things? I realize it's a punt as an answer to the question. It's a double punt. That's not our job. We just do what Washington tells us. But right. B, Washington doesn't have an answer to that yet. It's supposed to come on May the 1st. So I think we got to see what that says.
I'll call you on May 1st, see what you think then. So kind of getting back to the flex earlier about Chicago and the Midwest having a more balkanized banking market than perhaps other cities do. Does the Fed have any role in helping to instill confidence in those smaller banks, especially in a moment like this where people might be rattled, and do the flight to safety to large banks that are perceived to be more stable?
Yes and not yes, at the same time. And by that I mean, yes, the Fed system, if you're if you're a bank, an actual bank, not a shadow bank, from the beginning, the Federal Reserve Act of 1913 is created in response to banking panics. And they set up a discount window, which is the lender of last resort that the Fed has. And the reason the Fed is the lender of last resort is you can stop banking panics if people see, oh, wait a second. So if the bank is solvent, they just can't get cash right now, they could go to the Fed and they could borrow money from the discount window. And so in that sense, the Fed is a critical linchpin for confidence in the whole banking system, especially at small banks. You don't have to worry. You got FDIC deposit insurance. If your bank is solvent, they can go to the Fed and borrow at the discount window, and that's a well-established, more than 100 years system. The sense in which not yes is it's not the Fed's job, and it would not be appropriate, and it would probably be illegal to get up and say, bank so-and-so is totally safe. The supervisory information is classified, secret, whatever. I'm gonna get in trouble for saying the wrong level.
You're in so much
it's
trouble
SCI
already.
clearance, like whatever it is.
Yeah.
So we can't say that, and it wouldn't be appropriate. If you're the supervisor, you shouldn't be supervisor plus cheerleader of go out and say, oh, everything is great and it'll be. You should evaluate what the conditions are. Right. And if banks mess up, you should correct them and say you're deficient level 2, and whatever it is. So I think the Fed is critical for the system of confidence in the financial system, and credibility of the Fed is super important. My old great mentor was Paul Volcker, and I went through the financial crisis as the chief economist for Paul Volcker's advisory board. And Paul Volcker's thing, always, I would constantly ask him, what was it like in 1982, when you raised the interest rate to 20%? Were people mad? Yes, they were mad.
Yes, they were mad. They were mad.
But his thing is, when a crisis comes, the only true asset is your credibility. And his view was, he didn't mind making himself look bad in non-crisis times. If you'd be like, oh, he said that, that's embarrassing for yourself. If it was putting coins into the credibility piggy bank. He was okay with that because his view was, one of these days we're gonna need it. And you're gonna believe me because I always tell it like it is, even when it makes me look bad. And I do think that same Fed credibility is, in a weird way, quite influential on the confidence that people have in regional banks and in small banks. They know it's backed by the Fed.
Yeah, well, and credibility and confidence is really what keeps financial markets rolling no matter where you are, right? I mean, it's all built on faith.
You're making me think you're a financial dominance person. And I'm like, whoa, wait a second, what?
But let me ask you this. We only have, almost 4 minutes left. So I did want to ask you kind of a big picture question before.
That was a polite way to say I got to be tighter. I can.
No. You can talk all day. I'm happy to listen. But no, I just, because I know we have kids who are probably about the same age, and I've just was having a conversation with them recently, they're in their 20s, I've been telling them really ever since Donald Trump took that golden escalator ride, I've been telling my kids, pay attention to everything that's happening right now, because your kids and your grandchildren are going to be asking you, what was it like to live through this time?
Yes.
It's just been wild, let's face it. And and occasionally I've had to also tell them, the arc of history, try to rely on some of those big picture takes to help them get through some of the stress of this moment. What do you tell the young people in your life about the time that we're living through and how to think of it and how to prepare for what's ahead?
Wow, that is a deep question. And I guess we have 2 minutes, so what am I going to say?
Let's see.
Our kids have a tendency to say, we're walking a kid to school, somebody says, hi, Addison. He doesn't say anything, our son Addison, he doesn't say anything, walks by. My wife's like, when people say hi, you got to say hi. This isn't the 1980s, Mom. What
was it about
is
the
that?
80s?
No, what it is, people don't say hello anymore?
Right, yeah.
I actually have been, from my time teaching at Chicago Business School, I'm a huge fan. You hear people say, millennials, they don't want to work, they don't ambitious. I haven't found that to be true at all. I've been super impressed.
Same.
And I guess in a way, my inner message, I'm not going to say it to the kids because it would connote them, don't listen to what I'm telling you, but I hope that kids their age, they do it a different way. Like, look at all the stuff we screwed up. Like, maybe they can do it different. I think at one point, somebody's great grandmother who's 100, COVID had begun, and they asked, and they lived through the Depression and World War II and a bunch of stuff, and said, where does this rank in all the stuff that's happened in your life? And the great grandmother said, this is the biggest thing that's ever happened. This was bigger. She was like, I was in World War II. I was in, I lived through the Depression. It wasn't as crazy as this. I was like, oh no. It was like in the, it's like in my parents one time got stuck in the elevator and the door opening. There were a bunch of people in the elevator. The door opens and they're in between the floors.
Oh, geez.
And they ring the alarm and the repair guy comes running up and they said, and they just hear him say, oh no. And it was like, that's the last thing you want to hear from the elevator repair guy. So I'll say that. But in our last, let me say one thing. In a way, it is sort of about posterity and not exactly geared to young people, but it comes from your thing. You said, we actually have a lot of small companies and we have a lot of small banks. sometimes you can look at Chicago and you can kind of be a little nervous and look at urban areas. And as we come out of the pandemic, there's been this argument, is this the death of all cities? And is Chicago doomed? And all I will say is there's a urban economist at Harvard named Ed Glazer who has this paper which looked over 80, 100 years at cities and metro areas around the United States and who have succeeded decade after decade and who have gone down. And he actually found that 3 things characterize cities that grow versus cities that fail. The first is not a ton we can do about. Since the invention of air conditioning, places that are warmer in January have done better. They've moved to hot places. 2 is what's the average educational base of the workforce. And 3 is how diversified is the economy in both industry and size of company. And one company towns have not done as well.
Yeah.
If you look at Chicago, January still stinks, but we actually have had pretty successful urban education compared to with other large urban areas. We can't neglect it. We took huge blows through the pandemic. All urban areas have.
Yeah.
But that's not a point of problem for us. And we're a very diverse local economy. We have a lot of small firms as well as big firms and medium-sized firms. Our financial system is spread. So in a way, kind of the fundamental, I don't exactly know how it plays out. And people are like, but the parking meters, we sold off the parking meters. They're like, fine. Whatever. Argue about any policy.
Right.
The fundamentals are not bad. As an urban area, if those factors continue going forward, I still am pretty bullish on
It's good to talk
region.
to someone else who's long on Chicago. I'm bullish on Chicago too. Thanks so much.